All right, so I wanted to talk about the new FHA guideline as it relates to student loans, and so I'm excited about it. I'm happy for a lot of people that's looking to buy a home that couldn't purchase a home before because of the student loans, and that was always my biggest issue when it came to student loans. And I know the Biden administration, they were working towards getting I think like 50,000 or some kind of amount forgiven, which I'm cool with that, and that's great. And but me having my experience in the mortgage industry, I saw a lot of people that were very educated and had decent credit scores, had decent income, but because of how the banks calculated the student loan payments, that kicked a lot of people out. So I'm happy to see that there's been some changes, and there's some new guidelines that I think is going to take effect August the 16th. So typically the FHA loan is a government-backed loan, and your down payment requirement is 3.5%. And the way that they used to calculate the student loan payments was 1.15% of your total student loan balance. And typically they didn't go with what was on your credit report, because a lot of people are on the income-based repayment plan where you owe $100,000 in student loans, but you're only paying like $10 a month or whatever. So the way that they would used to calculate it is 1.15% of the total loan balance. And so what that means is that, let's just say, for instance, you got $100,000 in student loans, where 1.15%, you're looking at $1,100 that they're using to add to your debt. So all of your other debts that you have, and then they would calculate your debt to income ratio, which that's something I'm going to talk about in a few moments, is how to calculate your debt to income ratio. So that's huge, because now if you have $100,000 in student loans, well, the way that the guideline is going to read now is that they'll go with what's on your credit report, as long as it's I think above zero. Matter of fact, let me just read what it says. It says, for outstanding student loans, regardless of payment status, the mortgagee must use the payment amount reported on the credit report or the annual documented payment when the payment amount is above zero, or 0.5% of the outstanding loan balance when the monthly payment reported on the borrower's credit report is zero. So if on your credit report it shows zero, because let's say, for instance, you're on an income-based repayment plan and your payment is zero, well, they're going to use the 0.5%. Well, let's say, for instance, on your credit report it's reporting that you're making, $100 a month or something like that. Well, that's the amount that's going to get used, because it's above zero, according to the guidelines by HUD. Now, you also got to keep in mind too that just because these are the guidelines by HUD and FHA, that doesn't necessarily mean that the bank is going to be required to adapt that. Banks have what's called overlays, and I don't know if anybody knows what that means, but overlays is basically, there's this, guideline in place based upon the program itself. So let's say FHA, for example, and let's say, for example, it's 580 credit score where you can get an FHA loan. Well, the lender can put a guideline on top of that. They can put an overlay. They can, because the lender just cares about their risk. And so it's like, yeah, we know what the guideline is, but in order to protect, our investment, we're going to add to that and say, okay, you need a 620 credit score or a 640 credit score. So I can almost imagine that some lenders will probably still implement their own overlays on top of what HUD is requiring, but there are a lot of lenders out there that go strictly with whatever the guidelines are that's put out on, like FHA loans and VA loans. So that's a big thing. So let's say, for instance, you got $100,000 in student loans. So instead of them using the $1,150 or whatever as added to your debt, now it's going to be, at the most $500 added to your debt to income ratio. And that extra $600 can make a difference on whether somebody qualifies for a mortgage or not. And so that's huge. That's big. One of the things that they acknowledged in, with HUD and kind of with the whole setup behind everything is to kind of stimulate and basically encourage more home ownership amongst minorities, amongst blacks and Hispanics. And so because apparently somebody recognized that there was a big deficit when it came to that. And not just saying that, that those are the only groups that have the issues when it comes to student loans, but, let's face it, a lot of us didn't have, money saved up for school, or maybe the parents couldn't afford to pay school. So we went out and got student loans, because we were told that, hey, go out and get this education. Well, it got to a point to where a bachelor degree wasn't enough. And so we went and got master's and doctor's degrees. And, with my credit repair business, Exodus Credit Services, one of the things that I noticed amongst the people that I was working with, or that I work with, and those that were dealing with credit issues, more so student loan credit issues, was that there was a large number of black females that were, at this deficit. Some of them had decent credit scores, they make decent income, but because of the student loans and how the student loans were calculated, they couldn't qualify for mortgages. And that's so unfortunate, because you look at that group of people, and that basically has caught it for years, and was always told that there were not enough, and that they didn't match up to, not just the black men, but, other male counterparts, or just anybody. And so, what our sisters did, they went out and got their education, because, they just fight like that, and they're strong and resilient. And so they went out and got educated with bachelor's degrees, master's degrees, and even doctorate degrees. And so they went out and got educated, but these student loans are, was holding a lot of them back from becoming homeowners. And we all know that one of the ways to generate wealth is through home ownership, and so there's a large group of people that's getting left out of that because of the student loan thing. So I'm excited about that. Was one of the things I would always tell people, that I would want to put something together and send to the Biden administration to say, hey, thank you for, trying to do something with student loan amounts, but something needs to be done about how these banks are calculating these student loans, because a lot of people are getting left out of what would consider the American dream, when all they did was just done what they were told to do, and that's to go to school and get education. And of course they had to use student loans. So that's huge. So if you had student loans, and if you talked to a lender and you was trying to get a mortgage and they declined you because of your student loan debt, then I would recommend you looking at it. Now, the other thing I want to talk about was the debt to income ratio. How do you calculate debt to income ratios, typically from a lender standpoint? I'm just going to keep it very simple. I'm not going to get too complicated, because it can, just depending on what type of employment you have. Do you work hourly? Do you work salary? How long you've been on your job? So I'm just going to take a salary scenario, right? And let's just say you make $5,000 a month gross, because that's what the lenders look at. They look at your gross income, and you've been on your job for 2 years, and you make $5,000 a month. Well, a lot of guidelines require like 43 or 45% debt to income ratio. FHA actually goes up to 55% debt to income ratio. That's their guideline. And so, just for numbers' sake, to keep it simple, because I don't have a calculator right now, and I'm not going to go and get one, but let's say, for instance, you make $5,000 a month gross income, and you're in a loan program that allows you to go up to 50% debt to income ratio. That's the guideline, 50%. That means they'll allow 50% of that gross income to be allocated for your monthly expenses that's on your credit report. Keep that in mind, and your new mortgage payment. So when it comes to calculating your debt to income ratio, you take your expenses, let's say, that's on your credit report. So if you don't take a cell phone or a light bill or water bill, you don't calculate that. Now, if you're paying child support and it's coming out of your check, you're going to have to calculate that, even though that's not on your credit report. Or if you are paying back some type of federal tax, or paying back some kind of taxes or something like that. A lot of times, once they get your tax return and stuff like that, they'll figure out that you got these monthly payments. But just to keep it simple, let's say, for example, you have, $5,000 gross income, right? And the most that you can spend or go up to is, let's say, $2,500 because that's 50%. And so you just got to check with your lender. Hey, what's your debt to income ratio on this particular program? Or what's the debt to income guideline on this particular program? So 5,000 gross. And the most your expenses can be, including your new mortgage, is $2,500. So let's say, for instance, you got $1,000, I don't know. Let's say you got a $500 loan, just an installment loan, and you have a $500 car payment, right? So that's $1,000 right there. $500 installment loan, $500 car payment. That's $1,000 that you've used up out of your $2,500. And then let's say you have some credit cards or whatever, because credit cards on your credit report, and your total credit card payments come up to about $100. So that's $1,100 that you've used up already. And so that only leaves about we're trying to get to 2,500, so that only leaves $1,400 left for a mortgage payment. Now, let's say, for instance, you have student loans, and the way that they calculate the student loans now, let's say, for instance, it's $400, it comes up to about $400. Well, so now the most that you can spend on a monthly mortgage note is $1,000, right? And so that's how the bank will say, okay, this is how much you can qualify for. The most you can qualify for is $1,000 loan payment, and that's going to put you at, maybe 110, 120, depends on the taxes and the homeowner's insurance. So that's okay, you qualify for a $120,000 loan. So that's how the numbers are factored in. The way that you can do it, you can just go down the line and say, okay, here's my car note, here's this, and that. Like I said, just count the things that's on your credit report, unless you got taxes that come out of your, you're paying back taxes or whatever, or you're paying child support, because they're going to see that on your paycheck. So let's just for simplicity, let's just take it to where, you wrote down all your bills or whatever and things that are on your credit report, and it comes up to $1,100. What you do is you take that $1,100. So here's the formula here. You take the $1,100, divide that by your $5,000 a month gross income, and that's going to equal like point whatever. So it's going to equal, let's say, 0.35% or 0.38%. So that means your debt to income ratio at that point is 38%. So once again, take your total amount of expenses, your bills or what have you, and then, divide by $5,000 or whatever your gross income is before taxes, and that will equal your debt to income ratio. So hopefully that's simple for you. I wanted to do it on the computer because I was going to actually just kind of do the math a little bit better for you so you can see it. But the simplest way to understand it is take your expenses, divide by your gross income, your monthly gross income, and then that will equal your debt to income ratio, 0.4, 0.5. The program, the guideline allows you to go up to 50%, and you do your math and you see you at 52%, well, you're over the threshold, you're over the debt to income ratio. And so therefore you got to look at, okay, where can things can be cut back? Some people have to refinance their car or, pay off their credit cards or whatever like that. So that's the formula. That's how you calculate it. As always, if you have any questions and, you need somebody to, look at it for you, I can help you out with that. I'm not going to be able to spend a lot of time on it, but I can help a few people out, on, okay, how do I calculate my debt to income ratio? Really, what the formula that I gave you is pretty simple, and you can do it on yourself, but on your own. But if you have any questions, don't hesitate to ask. If you have any credit questions, let me know. Definitely shoot me an inbox. If you want to keep your stuff private, I understand it. I get it. Not everybody want to put out there that they need credit help. I get it. So definitely hit me up. Hit me up through email, info@exoduscreditservices.com. If you need credit repair services, and you don't want to do it yourself, exoduscreditservices.com. And I was going to save this announcement for another time, but I also have a platform where people can, if you want to do the credit repair yourself, I have a platform that's free where you don't have to pay for credit repair services. So if you feel like, okay, I'm well versed, or I want to get well versed, but I can't really afford to pay somebody to help me fix my credit, but I want to put in the work. Well, I have a platform where it doesn't cost you anything for credit repair. The only thing we ask for you to do is to take care of the credit monitoring service, the monthly credit monitoring service. That's another company that you pay, but you don't have to pay us for credit repair services. And that website is repairmycredit4, that's the number 4, free.com. repairmycredit4free.com. You can go there and get signed up too. So hopefully this is helpful. Hopefully somebody can take something from this and get it. If this doesn't apply to you, but you know some people it can apply to, just share it and let people know. All right. So once again, the FHA has redone how they're going to calculate student loans, and definitely going to be to your advantage if you've been held up from getting a mortgage because of your student loans. And then the debt to income ratio, I talked about how you can calculate that. All right, so I got to run. It was good seeing whoever was here. I'm not really reading any comments right now, so I don't, even if there is any, but like I said, just shoot me some inboxes or whatever, and I'll be happy to answer any questions that you may have.